Hey everybody, Ashley Page here. As always, thank you for joining us for our educational vlog this week. As we often say, for those of you who are new to the educational vlog, what we try to do with that is we try to do a deep dive on one subject and one subject only to kind of help build your library, as it were, on understanding of money and markets. That's in compare and contrast to the portfolio vlog that the guys do on Monday that tries to give you a good broad base of what we're seeing for the week. And also on Tuesday, what you get in from email, which are the research from a lot of our research partners. But we like to try to go a little bit deeper. So let's do that today on a topic that we feel like is very timely, but we want you to help you understand it at a deeper level. So the title of this vlog is, what are we really looking for in the current banking situation? What are we really looking for in the current banking situation? You all have followed everything with it over the last 2 or 3 weeks. We've had a lot of large headlines there. And so we wanted to go a little bit deeper to tell you what we at FiPlan are really watching for in this situation that maybe does not match up to the headlines that you see. So what we're really looking for in this current banking situation is simply this. What I should say, will ultimately be the impact in small and medium-sized banks, not the large ones that we've seen, but the small and medium-sized banks, because that's what's got the most broad-based impact in the United States to impact lending of consumer, commercial, all types. So let's rewind a little bit and let's look at what's kind of happened at the large-scale headline risk. An economist that we follow is Greg Draco, who's with EY Parthenon. They're the consulting arm of Ernst & Young. And we find that they have a lot of very good data in the financial institution space. And so I want to give proper credit for Greg coming up with this phrase. He said that with Silicon Valley Bank, with the Credit Suisse, with the Republic banks of the world, the high-profile banks, those are really the spark many times in these larger banks that sort of get everything else going. Around here, our expression of that is those events have a tendency to be the beginning of the noise in the machine that spreads itself out. So if you look at what happened with Credit Suisse, which we looked at all 4 of those banks, it really is what we call a liquidity issue. Primarily, what happened is the deposits started leaving all of those quickly. The Credit Suisse situation is a little bit different with a European bank because the banking system in Europe is just different. How does it vary from the United States? Europe does not have what we call a capital market. And what that is where companies can go in the open market, issue commercial paper, and fund themselves that way. If you are growing your business in Europe, other than an investment you put in yourself, almost all credit comes from commercial banks. Europe does not have a capital market per se. In the United States, we're advantaged because we have both. We have an active commercial paper market, capital market. We have an active commercial banking market. So U.S. companies have got a couple of different ways that they can go depending upon how they want to fund themselves. So what you've seen so far is what we call the high-level risk that many times, as Greg Draco says, will start this type of impact. What you really need to know is that this will become a problem trend only if we see it starting to permeate itself in the small to medium-sized banks in the United States, not the top 25 that Silicon Valley Bank was, not of that size, but the size below that, the banks that are less or below the 25 largest asset banks in the United States. Of all the lending in the United States, 38%, whether it be consumer or commercial, comes from small to medium-sized commercial banks and credit unions. That's a lot nationally. When you consider how much large lending is done through the capital markets with large companies, that's still a very significant percentage of credit that gets out into the system in the United States. So that's first. The second figure we'll give you is 28%. To drill down a little bit, the 38% is total loan volume from that group. 28% is how much goes in the commercial loans, general commercial loans, say for equipment and inventory and things like that. But here's the really large figure that got all of our attention, and it's the next one, 67%. 67% of the commercial real estate projects that happen in the owner-managed business sector and, more medium market cities like where we're located in Birmingham, 67% of that type of loan class is done by small to medium-sized banks and credit unions. Now, let me tell you what's significant about that. We work with a lot of financial institutions here, so we see a lot of those type of credits that are involved with the clients that we have, which are mostly in the state of Alabama. There's a heavy multiplier effect when you do a commercial real estate loan. Think about it. It's not just the loan going out into the system, but when you have a project of that size in, say, a medium-sized town in Alabama, it's a large leg for a town like that, a lot of multiplier. Why? You're hiring architects, you're hiring structural engineers, you're hiring a good construction company, you're hiring your legal firm to check the zoning and the easements and things like that. You're hiring your accounting firm to make sure that the depreciation schedule in the new building is correct. You're hiring lawyers to close the transaction. There's a lot of money that is spent in a community around a transaction like that. So if there's any one fulcrum point we're really watching in this banking climate with what's going on, is what the small to medium-sized credit unions and banks are going to do in that commercial real estate lending space, because that really has a tendency to spread out in the small markets and among owner-managed business. And guess what, folks? That's where most of the growth comes in the United States. I've told our CEO, Greg Powell, many years ago, when I started working with the banks in my own career, there were a lot of Fortune 500 companies in Alabama. Now you can count those on less than one hand. Most of the employment in the state is in owner-managed businesses. That's where it is. So that's what we're really watching in the banking situation right now, is not so much of what's going on with these large banks. That gets it started. It's what's going to be happening in this lower tier. That's what you really need to pay attention to. A couple of other things before we'll let you go on that we're looking at economically in a larger sense. You've got to realize, too, that what happens is when these small and medium-sized banks start getting in a crisis like this, they really watch their liquidity ratios and they get stricter about lending. Now, keep in mind, that's beginning to happen already on the back of the end of last year, end of 2022, when the rates started to rise. So credit was already getting tougher because it was more expensive. Now what we're watching is the second dynamic of these small and medium banks in their capital structure to see if they start to slow it down from their perspective, like many borrowers have started to slow it down from the rate perspective. We'll end with one piece of optimism and good news, because we like to do that too. We will tell you that the overall financial system that we're in is extraordinarily solid. It really was improved out of the backside of 2008, where a lot of these liquidity ratios were the Federal Reserve calls and FDIC to call for a good bit of improvement on those. So one thing that we will tell you, lo these many years later, that one thing that was helpful from the 2008 financial crisis is that these liquidity rules in banks got tighter. So even though we're seeing some of this now, we're in a lot better shape to withstand it. So do we think there's going to be any other widespread problem in the financial crisis? No, it's much better protected now than it was in 2008. But again, the key to look for is what happens in the owner-managed business market with the small and medium-sized banks. That's really going to have an impact on what we see in the economy this year in 2023. So we hope this has been a little bit helpful in kind of digging below the headlines somewhat. As always, we love to hear from you. You are welcome to call me to talk more about this individual topic, or anybody else on the portfolio team. Reach out to us on any social media platform. But as we always say when we close the blog, we're Southerners, so we love it when people call on the good old-fashioned landline phone or come by to see us. So we hope you have a great rest of the week, and we'll talk to you soon. Thanks.